Is America's economic engine running hotter than the headlines suggest? Bank of America CEO Brian Moynihan shares why he's not worried about a recession, how consumer spending is defying the skeptics, and why AI is quietly revolutionizing the banking world behind the scenes.
As you go forward, though, what we have that's unique is we get to see the data, what our consumers are doing. And so if you look at them during the second quarter, April, May, June, April, May slowed down a little bit, Liberation Day. June kicked back up, and July has been stronger. So for the month of July 2025 versus the month of July 2024, our consumers pushed 5% more plus into the economy from their accounts.
In terms of spending?
Credit card, debit card, checks written, money out, cash out of the ATMs and spent, Zelle payments, wires, ACH, all this, 5.5% more, which shows you that they're still in the game and pushing. Now it's interesting, a little bit more quick service restaurants versus higher end restaurants, or a little bit more at close because of summer building into school versus something else. Entertainment's strong. Flights have come back a little bit. It's a lot of different nuances, but at the end of the day, they're just spending more money, and that's not a small sample size. It's $2.5 trillion so far this year.
And what do you see between the distinction of people's actual outlay of cash versus looking for credit from you?
The credit quality of our customer base is very strong, and in the industry is very strong. You just saw the Fed stress test, so the credit quality is strong. The capacity to be able to borrow is high. Lines of credit usage for consumers for the home equity loans are still down 30% from where they were pre-pandemic, and house prices have gone up. So the capacity's there, the delinquencies are good, are trailing down, and so they have capacity. When you look at different segments, the median income, twice median income consumer gets a little more stretched, and you can see them move around a little bit more. You can look at Gen Z spending a little bit less growth over last year, all growing, but you can see older cohorts spending more, probably because they're cash flowing. So all the issues are out there, all the hearings, but I always say, don't listen to what people say they're going to do. Listen to what they do, and what they're doing is still spending money, which bodes well for even with the tariffs, that this thing keeps working through the system.
Okay, so that's a question, though. If you look at those numbers, the spending numbers, and you sit around and then look at the employment numbers, you see a disconnect.
Right.
And what would your economy, when you sit around the table, what do they say to you?
Well, the disconnect is job growth, and that's what got restated, and we can talk about that. But the real factor is the unemployment rate in the U.S. at 4.2, plus or minus, is through full employment. And what our economists actually say is the supply of labor is going to be a constraint on job growth, not the demand for labor. And so that, frankly, leads to potentially wage inflation. So they're saying because of change in immigration rules and regulations, because of just the dynamics that we have to grow workers every year to keep this great economy going. And so they're saying that the hesitancy around corporations to act, given all the uncertainty they're facing, hiring and stuff, has slowed down hiring, but it doesn't mean they're laying people off en masse. And that's the distinction that gets lost. So yes, you saw a revaluation of the job growth. Yes, but unemployment is still 4.2%. Andrew, for most of our business careers, 5.5 was considered to be full employment. We're way through that.
Tariffs.
Yeah.
Do you think we've actually seen an impact? And do you think that we're going to see an impact? Meaning, is it already baked into the market or not?
I think what our clients, I was just in the Midwest in a bunch of Midwestern cities the last month talking to middle market companies and smaller businesses. And if you listen to them, the number one thing about the tariffs is they just want to know what the answer is. And if it's really bad, maybe they don't want to know the answer. But as long as it's within the range that's being talked about, they can adjust to that. They can start to make it. But it affects everybody. It affects people from the standpoint everybody is buying inputs either to remanufacture and take out, or importing and selling, or frankly, the pricing around them is affected. And it's because different countries have different rates. If I got my stuff from Vietnam and somebody else got their stuff from Mexico, we might have different pricing. So they just want to know the answer. What I think has happened from Liberation Day to now, you're starting to see the goalpost set. The outside goalpost to maybe 30% or something like that seems to be the high end, and then the low end 10%. So people are starting to say, okay, I can at least plan. But they've got to plan their business cycle for next year. They're already making the plans as they move into the fall for 26, and what they'd like to see certainty. And so I think you hear that in Secretary of State and others saying we're going to get these deals done so people then can plan, and then you can see the economy come out the other side.
One of the reasons the market seems like it's been as resilient as has been AI, and you're investing hugely in AI. But I'm also curious, you probably have a lot of clients coming to you saying, I want a big loan because we got to go build some data centers. How are you thinking about making loans in the data center market, or even around the sort of AI ecosystem when it comes to energy and energy companies? Because there is also a question as to whether we are living in some kind of enormous bubble and we don't know it.
So looking ourselves as a consumer of data, information, data center capacity, we have 30 data centers, and we also buy outside. You can see there's just a relentless need for information technology, computer processing, and now these GPUs, a special case. So that's going on. How we actually underwrite credit is we look at it. What's different about these is a lot of them are being built with big purchase commitments for very powerful companies on the other side. In other words, I will take the 100% of the data center down, and by the way, I'll buy the power for the data center, which is a little different than building something on spec. So think of a fully tenanted up building. It's a lot easier to lend against that than it is against it. Look, the power of AI is interesting, but it's a continuation of a theme. In 2010, when the team took over, we had 285,000 people. We went up to 305,000 people. We have 212,000 people. That's all application of technology. Our company's bigger, more transactions, more regulatory rules.
Right.
You have 8,000 people in risk. We probably had 3,000 people back then. We have 1,000 auditors. We had 400. So all this infrastructure, yet the headcounts come down. So the amount of people working on a retail system that is almost tripled in size is basically half of what it was back then. That's all application technology. What AI gives you is a place to go that is far different, because it takes people like you and me who read stuff, put it through our brains, and came out with what to do about it. It provides an ability to make teammates who can use it much more effective. That's why I think the promise is there, because it goes against jobs that are different. Now, our job as management is to manage that human being question carefully, and we did it for the last 15 years, going down 80,000 people in total, and we got to manage it. And that's why I say to my team, we should not be hiring people unless we're sure they're going to survive our application technology.